In this week's video, we'll review the latest charts, data sets, and studies to help us understand why long-term evidence continues to support the secular trend thesis for stocks. We've got a lot of material to cover, so feel free to use the pause button on your video player. Last week we talked about the charts and data sets that we had in front of us a week ago, told us to keep an open mind about better than expected outcomes the week of Jackson Hole. Fast forward a week to Friday, August 27th. The S&P 500 intraday on Friday was up 60 points for the week. The bar graph and research shown on the left side of your screen comes from LPL Research via Ryan Dietrich's Twitter handle. LPL has identified the cases going back to 1950 where the S&P 500 index was up at least 15% year to date at the end of August. In their bar graph, the orange bars show the final 4 months of the year. So in case number 1, at the end of August in 1954, the market was up 20.2%. The last 4 months of the year, it tacked on an additional 20.6%. There are 14 cases shown on your screen. 2 of them, 1986 and 1987, the market was negative after the end of August into year end. In the other 12 cases, the market continued to march higher between August 31st and year end. The average gain is shown on the right side of your screen, 7.33%. The median gain in those 12 cases was 5.4%. Thus, in roughly 87% of these 14 cases, good things happened between the end of August and the end of the year. We wanted to know, what did the maximum drawdown look like in each case from August 31st to the end of the year? So in this case, we're calculating the S&P 500's maximum 4-month drawdown. That would be in September, October, November, and December. Average drawdown, relatively muted, 5.3%. The median drawdown, just a hair over 3%. Worst case scenario, 1987. And since under our approach, we would be taking defensive action in this case, we wanted to know, how did the average and median drawdown look if we exclude that case? Because these would be cases where you would be trying to hold more of your assets relative to the 1987 case. In the 1987 case, the model would basically take over for us. In those 13 cases, last 4 months of the year, the average drawdown, 3.24%. The median drawdown, an incredibly muted 2.67%. With some back-of-the-envelope calculations and using the closing price for the S&P 500 on August 26th, so near month end, we're going to have to redo this at month end. This gives us a good idea, similar to other research we presented in the past and signals that we've covered in the past. In these cases, which would be the 13 of the 14 cases shown on your screen, excluding the 1987 case, for the most part, the June low of this year hypothetically once again would hold on any pullback. If you just look at this chart where my cursor's moving around, this is a natural area of possible support in this box here. And this is also an area of possible support, and for the most part, they intersect right around these lines here. Not a prediction in any shape, form, or fashion. What it helps us with, if the market moves from here down to here, it helps us understand the probability relative to the historical cases of the market righting itself and pushing higher. And then we learn something about probabilities if the market moves into these areas here on a pullback. If a pullback between now and year end stays in this region here where my cursor's moving around, it basically says for the most part we're staying on this historical script. And that's relevant because walking forward from the end of August in those cases, in every single case the stock market was higher 2 years later. So 2 years later at the end of August, the average gain was 20%, the median gain 12.39%. 4 years later, every single case the stock market was higher. The average gain an impressive 43.05%, the median gain 28.12%. And as we already covered, in most of the cases, with the exception of 1987, the drawdowns between now and year-end were for the most part tolerable. Also noteworthy, especially for long-time viewers and clients, these dates over here, if you know your market history, you know, very, very similar to the study that we covered back on April 2nd, where many of the dates or signals in that study occurred within the context of a secular trend. In this case, if we take the LPL research that we just covered based on this bar graph here where my cursor is, look how many of these cases occurred within the context of a secular bull market. For the most part, almost every single case. Telling us something that is most likely about to occur, because we need to hold on to a 15% year-to-date gain at the end of August. Something that is most likely about to occur within a matter of trading days aligns nicely with the overlay thesis, which is the present day we are also in the context of a secular trend driven for the most part by favorable demographics in the United States. Earlier this month, you may recall, we also took an LPL study, the table shown on the left side of your screen. Their fine piece of research told us that when the S&P 500 had a 6-month win streak, which was nailed down in the history books at the end of July, historically, good things tended to happen looking out 12 months. In the historical cases, the average gain 1 year out, 12%, the median gain was 10%. And that 6-month signal that occurred at the end of July, also from a historical perspective, produced drawdowns that for the most part, in most of the cases, would keep the S&P 500 above that June low. So the study that we covered on August 6th, and we covered the drawdowns for this table here as well, there's a good chance we're going to have a 7-month winning streak in the history books at the end of August. And if that were to happen, in those cases, we would want to calculate the 4-month maximum drawdown, and that's what we did here. Here's another set of data that's telling us it's reasonable, or at least from a probability perspective, reasonable to expect that any pullback that occurs between now and year-end has a decent chance of holding above the June low in the S&P 500 from 2021, which sits somewhere in the neighborhood of 4150 to 4175. And remember, in this case, we're assuming the S&P 500 completes August with a 7-month winning streak, and that's to be determined. That may or may not happen between now and month end, but if it does, this is what the 4-month drawdowns look like specifically in the historical cases. This table here was used to create this approximate drawdown chart here. Should be noted, we used closing prices from August 24th to produce this chart here. This needs to be updated as of month end. So if we do get to a 7-month winning streak, and the S&P 500 was up 75 points for the month as of the close on Thursday, August 26th, with only 3 trading days left in the books, that would be Friday, the day of Jackson Hole's speech for Powell, and the following Monday and Tuesday. If it can hold again into month end, and we do nail down that 7-month streak, once again, in those historical cases, for the most part, good things happened. Average gain looking out 2 years, 20% in the S&P 500. Median gain, 13%. Looking out 4 years, the average gain was 54.61%. The median gain, a hair under 50%, with 92% of the historical cases being positive. Also noteworthy, the case here where you see a lot of red in 2006, that is one of the cases that did not occur within the context of a secular trend. Another relevant point about the data that we've covered this week and the data that we've covered in recent weeks. What does a secular trend look like? Typically, it's a very, very strong, almost relentless trend in some cases. And most of the hypothetical drawdowns that we've covered in recent weeks, from an average and median perspective, tended to fall in the 2 to 5% range. And relative to a secular trend, the S&P 500 made a new closing high this week on Wednesday, August 25th at 44.96 and change, the figure shown where my cursor is. And hypothetically, if the S&P 500 experienced a 2%, a 3%, or a 5% pullback from this closing level, we'd fall in this area here, in the vicinity of an upward sloping 50-day moving average or possibly a 100-day moving average. Even if we saw a 10% drawdown, which is not a high probability event, it's never a zero probability event. Some of the historical cases do have drawdowns in the neighborhood of 10%. Even that, from the close on August 25th, would take us back hypothetically to an upward sloping 200-day moving average. Everything on the screen here, including where the pullbacks hypothetically would find buyers and then move on eventually to make new highs, including a pushback to this level, this is exactly what a strong or secular trend would look like. This is what we would expect it to look like, telling us that unless something changes in terms of our clients and our approach, the base case is to try to do as little as possible on relatively muted pullbacks. And if things get a little bit more dicey from a risk management perspective, you would also be in a position if you raise cash between point A and point B. Once the market shows something down here at point B, the base case would be to get that money back into the market extremely quickly. Why? Because strong secular trends have a tendency to go on to make higher highs. And based on what we know today, we have a very strong trend. And keep in mind, we also have signals in recent weeks that tie the present day to 1995. Here's 1995 right here where my cursor is. Look at the strength of the trend in the S&P 500 walking forward from 1995 to March of the year 2000. This look in here aligns nicely with the look here on August 25th of 2021. This is the IYW Technology ETF relative to TLT bonds. You can see the consolidation box here, the indecisiveness for several months, and a break to a new high in this area here during Friday's session. And in terms of the read on the markets heading into Jackson Hole, this is one example, a tweet on Wednesday of this week. The market was not really tipping its hand and saying it was particularly concerned about what was coming. In fact, a lot of charts that needed to show some improvement started to do so this week. Focusing back on this consolidation box here, not unusual for markets to consolidate their gains, not unusual to consolidate gains, not unusual to consolidate gains. The longer the breakout holds, the more relevant it becomes. It's also relevant that IYW is now making new highs relative to TLT. In this period here, especially since the February-March window of this year, very, very difficult to find any major ETF or sector, stock ETF or sector, that was making new highs relative to the S&P 500 and making new highs relative to TLT. IYW can now check that box. During Friday's session, a new high. This level here in the ratio is higher than this level here from February of this year, also higher than this level in September of last year. If we draw a horizontal line here, price, 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 this ratio really has not made a lot of progress over the past 12 months. The longer a market goes sideways, the bigger the move that you can expect to get. The longer the bullish breakout holds, the more relevant it becomes. SCHX, very, very similar to SPY. The S&P 500 itself still has some work to do relative to TLT. We'll learn something either way here. But if we take a step back, the shorter-term bias here does show improvement. But bigger picture in terms of how long the market can rally, this is still not as encouraging as this area in here. This consolidation tended to have a downward bias to it. this consolidation in here tends to have an upward bias to it. Here's a low, here's a higher low, and then the ratio starts to take off. We'd like to see something similar over here where this ratio moves in this direction following IYW and some other tech ETFs to new highs relative to TLT. So tech IYW making new highs over here relative to TLT. The S&P 500 itself close to making new highs relative to TLT. Not so with small caps. This is 11:02 a.m. on Friday, August 27th. This is still a relatively weak look. What does this tell us? It tells us that this look in here, which is not as strong as this look in here, and that's true for RSI down here as well. These are leadership and asset allocation charts. This downward bias over the past 6 months relative to this upward bias prior to this big move here between November and March of this year, it simply speaks to the odds of another move like this with similar leadership occurring in the present day. From a leadership perspective, it's quite a bit lower today than it was here in early November of last year. That doesn't mean small caps can't go up. It just says the leadership probabilities are lower today relative to where they were over here. Is that subject to change? Absolutely, positively, yes. Didn't look too good right here, and then things improved relatively quickly. Here's the move in the 10-year yield prior to November of last year. Here's the move in the rearview mirror with an indecisive look at the 38.2. You can pause your video player here. The present day look of this chart, a bullish breakout after consolidation. This is a breadth chart. Looks quite a bit better than the correction in 2004 S&P 500 here and the correction in 2010. This is the S&P 500 here. This is the same breadth indicator here. The longer this breakout holds, the more meaningful it becomes. As of August 25th, prior to Jackson Hole even, this chart looked a lot better than it did here or here. As always, we're speaking to the chart in front of us. If the chart changes, then our assessment of the probabilities will shift as well. Wanted to see this chart start to bounce. So far, it has. This is similar to the small cap chart, high beta and isolation, which tends to be mid-cap oriented, and these are the sectors, still had some work to do earlier this week. Think of this chart relative to tech growth in the S&P 500, all making new highs numerous times between June 1st and the present day. SP high beta on August 26th, not particularly close to making a new high yet. Here's another chart that said, not particularly surprising that the early read after Jackson Hole was favorable. This is improvement over the past several weeks. This is weak breadth down here, but it's been getting better. Another chart that told us to keep an open mind about good things happening after the Jackson Hole speech, August 25th. This is just a broader view held at a relatively important area down here and started to rally. Similar situation here, pre-Jackson Hole, August 25th. We were above this level here, 2010, above this level here, 2004. Probably safe to say after the close on Friday, August 27th, we will also be above this level. Similar situation here, pre-Jackson Hole, August 26th. S&P 500 drops, weakness in the market, weakness in the market. Below the orange line, below the orange line, below the orange line. Really haven't seen anything yet that looks particularly different than the rear view mirror for the broader market. Also, if we're expecting a rally in small caps similar to November of last year, here's November of last year. Notice the strength going forward in this breadth indicator. We need to see improvement here if we're expecting small caps to lead again. That absolutely may happen, but it hasn't happened yet. You can pause your video player here. Here's the indicator. Here's the S&P 500. It just didn't look that bad heading into Jackson Hole as of August 25th. Vulnerable, yes, but not particularly different than these vulnerable looks over here. IEF relative to SPY, sideways movement, indecisiveness. It looks like it's breaking to the downside against bonds. This is during Friday's session. Indecisiveness, QQQ for 5 months relative to TLT. It looks like it's trying to resolve to the upside. You can make an argument it's similar to this resolution here, November of last year. This is earlier this week heading into Jackson Hole. This is a monthly chart, so we're really going to have to see what it looks like at the end of the month and maybe over the next few months. Nothing really clear here yet, but the bias is for this to improve. And if we can clear this level over here from the year 2000 decisively, we would learn something about probabilities. Another chart, August 25th. There's nothing here heading into Jackson Hole that told us that the market was expecting really, really bad things to happen. This here looks quite a bit different than this look over here when the S&P 500 peaked in October of 2007. All of these charts we've covered numerous times. It just doesn't look that bad. You can pause your video player. Instead of breaking trend, we're making new highs in the present day. Somewhat vulnerable, but it's been improving lately. That's quite a bit different than this and this. This is the S&P 500 here. Everything that we've said about the previous charts applies here. During Friday's session at 11:35, we're not rolling over, we're making a new high. There's another chart pre-Jackson Hole. A lot of talk about market breadth being very, very weak, and there are some charts we've shown them that look vulnerable, but the weight of the evidence to date has not rolled over. This doesn't look that much different than this entire period here after the low in March of last year. We move into this area here, we'll learn something about bearish probabilities. Everything applies here, but this one looks even better relative to the concerning cases in the rearview mirror. August 26th, pre-Jackson Hole. Risky leveraged loans. Here's your level here from 2020. Bullish breakout consolidation above this level over here where my cursor is. During Friday's session, it looks like it's trying to push to a new high. From a virus perspective, it's important to keep this topic on our radar. You can pause your video player. Also noteworthy, heading into Jackson Hole, American Association of Individual Investors Sentiment Survey. Pessimism before Jackson Hole was above average for the 5th time in 6 weeks. That does not sound like what we would expect to see data-wise at a major peak in the stock market. If you're pessimistic for 5 out of the past 6 weeks, that may mean you have some cash on the sidelines. If you're overly optimistic, it probably means you're fully invested. And back to the concept of a secular trend. When we look at a table like this, so this is a table that we covered earlier in this week's video, it's very, very difficult to comprehend that the S&P 500 could be 43% higher on average in 4 years, or the median gain was 28%. We could have said the same thing about secular trends back in 2016. This video here, still on YouTube, dated December 23rd, 2016, told us to keep an open mind about better than expected outcomes over the next several years, as in 5 to 25 years. And at that time, it would have been very, very difficult to believe that something like this over here could have taken place between 2016 and 2021. How long will the secular trend thesis remain intact or the primary driver of our longer-term investment thesis? As long as the charts in front of us support that thesis. If they do, we learn something. And if they fail to support it, or if they start to contradict it, we'll learn something as well. And it's very, very easy when we use the term secular trend to start to believe that the stock market's going to go up every day, every week, every month, every quarter. That's just not the way that it works. I've been talking about secular trends for a long time, including all the way back in 2016. Between point A in 2016, December 2016, and point B today in 2021, there has been a ton of 100% normal and to be expected volatility that occurs within the context of even the strongest trends. The same is true going forward. To navigate between a point A and a point B that could be several years down the road, we have to be willing to withstand normal volatility along the way. And we know the way to handle this is the same as it always is. We'll head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Schx Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.